Welcome back, everybody. It's time for another weekly update. It is Tuesday, November 11th. Happy
Happy
Veterans Day.
Veterans, Happy
Amen.
Veterans Day.
Yeah. Thanks to all those who have served and given us the freedom to generate a podcast.
And do what we do.
They might regret it, but they did give it to us, so we're going to use it. Welcome back, everybody. This is a weekly update. I'm Clark Alexander. I'm here with Gary Pierce. Gary's in Texas. I'm in California. We are going to start with the big topic, which has been the topic every week for the last month or so, in government shutdown. What is the latest?
So the Senate voted last night approving their package. Today, the House will review and vote. I think it's at 4 o'clock this afternoon. Once they do, that goes to El Presidente and signature, and that should get everything back on track, going. And it's had some, obviously, hurt a lot of people, but as far as markets are concerned, the issues that we've been running up against, and the data is not available because the government's not producing it, essentially. So jobs data, inflation, things like that, which is definitely putting a strain on the Fed, because that's what they use to do that. And then all of that kind of trickles down into the mortgage industry. And so what we've seen, I guess, in the last week or so, there are some private kind of generated reports out of like the ADPs and consumer sentiment from University of Michigan and things like that. So we've seen some movement. We've seen consumer sentiment down. We've seen, jobs down. So there's been some movement. There's still, obviously inflation still sticky, still being talked about, but we need those reports to really get a good handle on what that's going to do for mortgage rates. I would say that in the last 2 weeks we're up up a little bit. We're still pricing in the low sixes today, but until we get those reports back and the government's back in kind of full swing generating those reports, we won't have a good handle and consistent message for rates until we know that. So I think we're going to stay pretty much the way we are without any kind of really big global impacts. Yeah. So
I see the chances of a rate cut in December they've dropped a little bit down to 64%.
Yep.
So the Fed meeting is going to go on, right? It's a December Fed meeting.
Yeah. So it'll be December 10th.
December 10th Fed meeting.
The question will be what kind of reports will we get before then?
Yep. Okay.
On that front.
All right. Well, good news. Hopefully everything goes smooth and we get people back to work and we get rates down with more data. Let's go.
Yep.
The next topic is an interesting curveball that's been thrown out to the market, and that is a 50-year mortgage. What are your thoughts on this, Gary? And do you think this has the potential to become a reality?
I think it's got a lot of potential to become a reality. Do I think it's a good idea? It's going to take a lot of education on our part for folks to understand what that means. So when you start adding 20 years onto the back end of a deal, that really, and you're putting the minimum down, that's where the people could get hurt. And that's where I'm concerned with, is seeing a low down payment not impacting principal balance fast enough to when they go to sell, whenever in the short term, call it 3 or 4 years, they have done nothing to that equity. And if we have a flat or even declining housing value market, that is going to be a problem. That's going to be some pretty upset folks.
It wouldn't take much for people to be upside down.
No, it really wouldn't. I mean, it's when you see across the board, 10, 15, 20% reduction in home values, which some markets are showing that today, and that's already happening. But then you stack a 50-year note on top of that, it's
It's the same math we're going to have to do on a cash out refi as being looking at, all right, you want to evaluate the 50-year? This is the interest you'll pay over the life of that mortgage, and this is all you're saving on a monthly payment. Yeah. Like those numbers, I think, are going to tell a very big story. Like, the extra 20 years adds a lot.
Yep. It definitely will. The question will be is what would pricing look like? Obviously, we don't know. This is still being, I think it's kicked around. It's not just being kicked around. I think they are working on this. The Housing Secretary, Bill Pulte, I think this was one of his babies, and, Trump is definitely behind it. So we'll have to see what the impact is. I don't love the idea out of the gates. If it can help people get into a manageable payment and they understand, both, pros and cons, home ownership is still home ownership, whether you're committed to it for 30 years or 50 years. You just got to work on, the biggest concern is, like, you got to understand the short-term risk. That's where it's going to hit you, because are people staying in a mortgage for 30 years or staying in a home for 30 years today? Not really. No, not happening. It's like 5 to 7 years on average, and they're out. You may refi even faster than that because you want to do cash out, or, the market, kind of corrects and you get lower payment or lower rates, and you have an opportunity for a rate and term reduction. I don't know. It's going to be a consultative kind of approach, and really that client understanding what the downside is, I think, is going to be the biggest thing for folks in our industry on the lending side. So I'm all for home affordability. I definitely think that it's been the last, call it 5-6 years since COVID, things have gotten way out of hand across the board. So if this is an opportunity to make it better, why not?
Case by case, got to look at it. See what makes sense.
Absolutely.
Then the last topic we have today, Gary, is Fannie Mae talking about dropping the minimum credit requirement. What is the latest on that? And we're going to have a full video overview of this, so we'll just touch on it briefly, but there's a full video that we'll put a link to. But what's your take on this?
Essentially, they are removing the 620 minimum credit score. That will go into effect next week. What that looks like from a pricing standpoint, I feel like it's going to cost money. I mean, just
somebody's paying for it.
Yeah, somebody's going to pay for it, and that looks like the client. Which, again, we've talked about this before. The higher the risk, the higher the cost. That's just the way it is.
The way it is.
I don't know if it replaces the need for those folks would traditionally be a ideal candidate for an FHA loan, right? As long as they fit the FHA guidelines, minimum loan amounts or maximum loan amounts, things like that. So income, if income, and so as long as there's the just the cost is palatable, right? It could make sense, because there are a lot of people that are in that 600, 620 range for whatever reason on the credit side. They do have cash. They're looking at a 650 loan amount. Well, you can't do that on an FHA deal, at least here locally in Texas. And so, the options, become very unlimited. You can't go very few options on the non-QM side where, you would do a bank statement loan, but that comes with a lot more freight as well. So, we're kind of TBD, but just want to kind of tee it up there, and we'll continue over the next few weeks to put out some videos to kind of explain what we're seeing. If we think it makes sense, we don't want to put our clients in a position where, short term or long term, it's a bad deal for them. So we'll take a look at the scenarios and definitely let you know.
Yeah, we'll put a link to the full discussion we have on this topic in the show notes here. Yeah. Awesome, Gary. Well, thanks for the time. This is a weekly update. Have a great week. I can't believe we're already at November, creeping up on Turkey Day.
Turkey Day is around the corner.
Gobble, gobble. We will be back next week for another episode. We'll give you an update on the shutdown, Fed meeting, things of that nature. We'll keep you posted. Gary, thanks as always. Have a great day.
See ya.